In 2024, we have seen some very strong performances across the board, yet when we take a look at Palantir, it is one of the best performing, up triple digits, although we do have to note when looking at the S&P as a whole on a forward P basis, not only is the whole market overvalued, but we can in fact see that Palantir itself is trading at a triple digit rate on a forward P perspective, which does question whether or not this company will continue to outperform over the next year into 2025. So we can see year to date 343%. It is trading right there towards its 52-week highs, although we do get 3 analysts right now calling this company a hold. Now, one of the reasons that we have seen it accelerate its top line growth is the fact that they continue to increase the number of contracts that they take on at a rapid rate, and just a few days ago they did announce an expansion from the defense sector with a $36.8 million contract with the US Special Operations Command. And there is no surprises when we take a look at their latest investor presentation. They are making deal after deal at some very high rates. In the more recent quarter, 104 deals of at least $1 million, and 16 of those were worth at least $10 million. So the growth continues that momentum on a week by week basis, and as we said, it is trading right now at a very high forward P. In fact, the information that sits here is 201. That is very, very crazy to think about. But let's dissect if this is one we should consider and whether or not we will see the same amount of gains into 2025, which would very likely make it another outperformer in 2025. Now, we also noticed that their earnings from the most recent quarter was very strong, hence why just off of that news, they were up around 20%. Not only did they continue to exceed on both the earnings per share as well as the revenue, but the guidance also looked fairly attractive. EPS 10 cents versus the 9 the market wanted to see, 726 on the top line versus the 701. And as we can see, when you compare that to the same quarter last year, their top line is up 30%. Now, you could question whether or not that is warranted for the continued increase in the share price of the company, but clearly investors do believe this is warranted. Following that, we also got an announcement that they are moving to the Nasdaq, which saw the share prices up 11%. And as we said, this is a company that does seem to continue to increase week on week, month on month, but we do also need to be a little bit level-headed to understand whether or not this will be able to continue. In terms of the earnings, well, the expectation over the next 4 quarters is of double digits, and they've also either outperformed or been in line over the last 4 quarters, which should give you some faith that in the next full accounting period with their earnings per share estimate, that will lower the forward P to 161. But again, you can see that is a very large number. They're going to have to increase, outperform, beat analyst targets, and go above and beyond expectations to continue this forward momentum. Doesn't mean it's not possible, but there is a lot we need to consider, and perhaps you do want a large margin of safety when we take a look at the model later on. In terms of the free cash flow per share, we want consistent increases over the longer term. Now, whilst we don't get that, we have seen them turn positive in 2021, and with a nice increase from 2023 to the trailing 12 month, we can see that anticipated 2024 will show that growth only moving forwards, and we have seen from their latest investor presentation for the full accounting year, they are anticipating $1 billion in terms of total free cash flow. Sales growth double digit every single year over the last 5 years and on a trailing 12 month. But again, you do need to bear in mind 2 things. One, is the growth that we are seeing justified for the forward P? And the second thing is, do we believe that this can continue? Moving on from a numerical perspective, and we will do a little bit of a run through later on, we can see their top line is up quite significantly just over the last few years. However, do bear in mind this is a company that has historically and in the more recent quarter diluted your position over the longer term. Now, typically, what we would say is this isn't a problem if they can continue to outperform the S&P, but with companies that dilute your position and underperform, that is where we do start to see this as a bit of a red flag indicator. ROIC, typically 10% or more, give us faith management are able to effectively allocate their capital. Now, we will come to show you this, but only recently they have started to turn into a net profit on the bottom line. Positive to note, it has been reducing and in fact turned into a positive 3% in 2023 and 8% on a trailing 12 month. The ideal scenario is here that it continues to increase over the longer term. And that is something that we would say on a lot of their margins, notably their operating margin, which is very low in 2023. Nice to see the jump on the trailing 12 month. However, on the free cash flow, looking very strong, double digit over the last 3 years. 40% on the trailing 12 month, and you would expect, given the valuation, that a lot of these metrics are going to be a lot better in a couple of years' time. Finally, the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization, showing us that over the last few years, on a trailing 12 month and over the next 12 months, it won't take Palantir one day to pay off all of their debt net of cash on hand, as these signal the number of years it would take them to pay it all off. And remember, this also correlates to balance sheet strength, showing us that their balance sheet overall does look very, very strong, and we will again come to highlight that. Now, we just want to let you know we have released our latest free weekly article where we run through one stock we are buying heavily in the month of December, and we deliver one of these to your article for free every Monday morning, where we cover severely undervalued stocks as well as what's gone in the market. So click below, you can sign up and start reading straight away, where you'll also be able to gain access to 28 undervalued stocks for the month of December. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a recently released copy of 29 stocks that Wall Street themselves believe right now in the S&P 500 have the most upside. So click below, you can sign up and start reading straight away. We also like to look at insiders and institutions, starting off with the insiders. 13% ownership, around 2.5 billion of shares being sold over the last year. And what we notice, the vast majority has just come in the most recent quarter. If you actually step back and look at 2024, as the share price has increased, insider selling has only got more and more significant. And when we do take a look to see who these insiders are, how much they're selling, we can see just the most recent insider sell was yesterday of around 416,000 shares, netting them $31 million. Now, we would say insider selling isn't necessarily a bearish signal. They sell for many reasons, personal or financial, but information is there if you want to use it in your own investment thesis. Then we flip over to the institutional aspect with 46% ownership, 1 billion worth of sales over the last year, more than 5 times the amount of buying during the same time period. So clearly they are very bullish, the institutions, on Palantir, as well as the fact that in the most recent quarter, they have been buying a lot of shares, a lot more than they have been selling. But do remember, one key thing that we do like to mention, always do your own due diligence. Never copy what these insiders or what the institutions do. Now, we've already flagged their total revenue looking decent, double-digit growth year on year, and we can see based on the trailing 12 month that is anticipated to continue into 2024. As we just saw, the most recent quarter, in fact, up around 30%. But really, we want to highlight the bottom line net income, something we haven't covered yet. And as we did say earlier, they haven't actually turned a profit until December 2023. Positive thing to note is on a trailing 12-month basis, this is anticipated to increase similar to their top line. So it does look like this company is only going from strength to strength. Now, we already mentioned that their balance sheet was very strong, but just to show you on a quick health check, total cash versus total debt, like their revenue, cash has increased over the period from 1.1 billion to 4.6 in the latest quarter. But why we compare it to their total debt numerically and directionally is because one number on this balance sheet won't tell us anything in pure isolation. And what we can see, their total debt has decreased, which is a very good sign. Cash increasing, debt decreasing, not something we see that often, going from 396 million in 2019 to 255 in the latest quarter. We then just very quickly want to flag the cash this company is generating from their operations, and whilst a little bit inconsistent, pretty much in line with their revenue, 712 million in December 2023, just under 1 billion in the trailing 12 month. Then we want to move on to some gradings. Now, absolutely no surprises that they get F on the valuation because their forward P at 201 is sitting well above the sector median of 26. Putting that into context, if you are someone who has recently or is looking to buy this company, right now you are paying a 665% premium to the sector median. And if you look at other metrics, in fact, it looks like an even larger premium. Does it mean it's not worth it? Does it mean it's worth it? The main question you first need to answer is, does this company deserve a premium? Second question is, how much of a premium? What margin of safety can we get? And that is what we are looking to answer. Well, look, they get an A on the growth, so that must mean they deserve or command some kind of a premium. 25% revenue year on year, sector at 4.6, 22% over the next 12 months, 5.6 sector median, and what we can see, their earnings per share over the next 3 to 5 years expected to grow at 28%, which is higher than essentially the sector at 15.3. Another reason why they deserve to trade at a premium, profitability, they get an A with their margin at 81% on a gross basis, 50 for the sector median. Bottom line, 18%, a lot better than the 4 of the sector median. And as we just mentioned earlier on, their cash from operations, whilst near the 1 billion mark, in comparison to others in the sector, sitting at 97 million. So quick recap for this part of the analysis, we do get a triple hold across the board and we see a F on valuation, A on growth with an A on profitability. So let's take a look now at the valuation of Palantir, and our intrinsic value comes at just under $60, which is a lot lower than the current price at 76. So how did we get it? We have the DCF model here with the free cash flow year on year. Average growth negative, it has gone from positive to negative, so that is a little bit skewed. But going with a 35% growth rate, what we have here is a low, medium and high. Based on that, with the discount rate at 8%, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see here, this would indicate a 22% decline, which basically tells us if you believe this company is going to be increasing its free cash flows at 35% over the next 10 years and beyond, this company looks overvalued. Now remember, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Palantir or any others. For full transparency, we will show you though, if you believe 30% to be more appropriate, the intrinsic value would be $45, giving downside of 41%. But if you believe that actually 40% is more appropriate, well, that pretty much tells us it's around the current trading price, 2% upside, which essentially is what this company has baked in terms of growth. It's trading like the free cash flows are going to grow at 40% year on year over the longer term. Now, as always, and very typical on this channel, we will use the medium rate today at 35%. And what we effectively like to do is add a margin of safety, starting off with 10%, executing on this if the company meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that, in today's episode, we'll buy around $53, and then we typically keep going till it's near the current trading price. But as we have mentioned, it is trading right now with no MOS. It is trading at a fairly large premium. Wall Street themselves, well, they see this company over the next 12 months at $75, downside of 1%. In essence, what they are saying is right now there is no upside over the next year, although that will depend on how this company does improve on the quarter by quarter earnings and other contracts that they do obtain. Remember, always take Wall Street's forecast with a pinch of salt. If the company performs very well, they'll increase the price forecast. If it performs very poor, they will revise it downwards. And just an interesting thing that we have performed here, if you see this company over the next year, 10 years or 20 years, getting to a 1 trillion market cap, then the price per share would be around $430. Again, just an exercise that we thought would be interesting to do, especially for those that do believe over the longer term that is achievable. As always, let us know your thoughts in the comments below. Don't forget to sign up to the free weekly newsletter. We are dropping a new copy Monday morning. Grab those spreadsheets, come and join us in the Patreon where we do talk about our weekly buys and sells. And as always, have a great one, and we'll see you on the next one.